Companies that are looking to access the capital markets for the first time are often surprised by the level of disclosure that they need to provide. Any company that is raising money in a capital markets transaction would have to provide disclosure, specific disclosure regarding their business, which may include disclosure regarding important customers or suppliers, risks related to the company, executive compensation disclosure, and then full-blown financial information, which would include audited balance sheet, income statement, statement of cash flows, and then footnotes to financial statements as well. Any company that's considering accessing the capital markets would need to consider the impact of the Sarbanes-Oxley Act and the testing of internal controls and procedures. It's a time-consuming process. There's a large upfront cost to doing testing for internal controls and procedures, particularly the first time around. There's a proposal out there by Congress to exempt smaller companies with a market cap of $75 million or more from the internal controls testing of Sarbanes-Oxley. If that were to be the case, then I think companies that are on the fringe of going public and are below that market cap may give additional consideration to accessing the capital markets. A company that's considering accessing the capital markets would need to carefully weigh the costs and benefits of the transaction, and costs would refer to actual costs, dollars out, as well as diversion of management's time and additional resources that would go towards becoming a public company or accessing the capital markets. Accessing the capital markets is a long process. I would say that the lead time to actually commencing a transaction is probably a year or so. And in that first year, you want to get your house in order, essentially. You want to start thinking about acting like a public company. You'd want to think about engaging auditors that are PCAOB certified so that their audit opinions could be filed with the SEC. Independent directors are going to carefully look at director and officer coverage that a company has. There was a WorldCom decision last year where the directors of WorldCom had to go out of pocket to satisfy fines that were imposed because the regulators were unwilling to have the D&O coverage cover the directors for their liabilities. The SEC has come out and stated that in this coming year's proxy season, they will be imposing additional disclosure on public companies regarding qualifications of directors specifically, and as well as composition of committees. Another area of concern for companies that are thinking of going public would have to do with really risk and risk assessment. And obviously the most prevalent one now is risk related to executive compensation. And we're seeing that now with the Payzar, and we saw that with AIG and some of the other big banks in terms of whether the risks that employees and management took with respect to companies was meant to maximize their income or was really meant to do what was in the best interest of the company. And so I don't think we'll see it this year, but probably by next year's annual reports there will be extensive requirements regarding disclosure of risk and the role that public company boards play in overseeing risk. As an alternative to an IPO, and we saw this during 2009, PIPEs, private investments in public equity, as well as registered direct offerings are always a potential alternative. A lot of the bank deals that were done when the financial institutions needed to enhance their capital were done through PIPE transactions, and there was a lot of publicity around Warren Buffett's investments in GE and in Goldman Sachs, both of which were done as PIPE transactions. We think that 2010 could potentially be a much better year. There are signs that the capital markets are loosening up, and in particular, if the IPO market does open up, we expect that there will be a good portfolio of companies that will be accessing the capital markets in 2010, particularly portfolio companies of private equity companies that have essentially been on the sidelines for the last year or so. Private equity firms will be looking for exits, and other than a sale, IPO is obviously the best exit for a portfolio company of a private equity firm.